Good morning. Let's look at how to compare industrial, retail, and multifamily returns and why smart commercial real estate investors actually measure them. Well, commercial real estate returns are not created equal. Industrial, retail, and multifamily assets each generate income differently, respond to economic cycles differently, and carry very different risk profiles. So, for investors and business owners evaluating opportunities in Houston, Katy, and Fulshear, understanding how to properly compare returns and not just headline cap rates is critical. Now, this guide breaks down the metrics that matter most and shows experienced investors how they evaluate true risk adjusted CRE performance. So, step one, stop comparing cap rates in isolation. So, cap rates are a good starting point, but never a decision making tool as a standalone, that is. A 6.5 industrial cap versus a 7% retail cap and a 5.5 multifamily cap may appear directly comparable, but they reflect very different assumptions around the lease structures, around the expense volatility, around the tenant's credit, around releasing risk, or even capital expenditures. And the point is, smart investors look deeper. So, industrial returns, stability through simplicity. Industrial assets, particularly single tenant and small bay logistics, are favored for predictable cash flow. And here's some reasons why industrial will pencil well. Typically, you have long leases, 5 to 10 years are common. Triple net structures reduce the expense risk over time for you as the investor. But there's also lower capital expenditures in those kinds of projects. So there's strong demand also from logistics, manufacturing, as well as service users. And some key return drivers are the debt yield, often stronger than other asset classes. And it's got a stable DSCR, even in higher rate environments. Let's come back to this one. There's lower management intensity. Now, industrial may not deliver the overall highest internal rate of return or IRR, but it often delivers the cleanest risk adjusted returns. So, retail returns yield, but with execution risk. And retail rewards investors who understand their tenant mix and location economics. And retail can outperform well when it's got anchored by a service based tenant. So, think medical, food, fitness. If it's located in high income or in high growth corridors, but also when leases include annual escalations and expense pass throughs. So, where investors can get burned through overestimating tenant durability or underwriting vacancy too aggressively or ignoring rollover clustering. So, if you have a bunch of people renewing around the same time. But retail often shows higher going in cap rates, but requires active asset management to sustain your returns. So let's look at multifamily returns. Scale with sensitivity. Multifamily remains capital's default asset class, but margins have compressed. So some multifamily strengths are you have multiple income streams, which can reduce single tenant credit risk. Your financing liquidity is the deepest. A lot of people like to lend money for apartments, but you also have long-term appreciation potential. Now let's look at some key challenges today. Operating costs are rising faster than rents are, and heavy reliance on rent growth assumptions can lead you holding the bag later. But there's also higher sensitivity to interest rates and insurance cost. And multifamily returns are increasingly execution dependent, not automatic. So let's look at the metrics that actually matter. And professional investors compare assets using a stacked approach and not just a single number. So let's look at the metric, why it matters. So cash on cash return measures immediate income performance. An IRR is a time weighted return, including your exit. And debt yield is a lender grade risk measurement, whereas DSCR is cash flow durability. And CapEx load is hidden return erosion. And releasing risk is income interruption exposure. Now, the point is the best asset is not one with the highest projected return, but the one with the most durable assumptions. So for the Houston area, here's the investor takeaway. In Katy, Fulshear, and West Houston, industrial dominates for stability and lender confidence. However, retail wins when service-based and neighborhood anchored. And multifamily requires conservative underwriting and patience. And returns are going to follow discipline, not any asset class hype. So make sure you choose wisely. Now, if you're comparing opportunities or refinancing an existing property, the structure of the deal often matters more than the sector's label. And that, my friends, is it for the day. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. Love to talk to you more.